Hello, chart watchers, and welcome to this Wednesday, January 16th, 2019 Market Watchers live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, it's much of the same. We've got the Dow Jones Industrial Average currently up 133 points, the S&P 500 up 7, the NASDAQ up 16, the Russell 2000 up nearly 7 points. 10-year Treasury yield testing some overhead yield resistance, getting close to that 2.75% area that was established about a week ago. We are up 2 basis points currently to 2.73%. Volatility index down close to 17.5 earlier today, has rebounded and has actually gone positive, even though the S&P 500 is up. So that's something maybe to keep an eye on later today. Financials, big sector today, leading number of areas driving financials higher. Investment services, you can see having a huge day today, breaking above some key moving averages, extending their recent move to the upside. Banks doing the same thing. There's some resistance at around 420. We cleared that early today and continue to trade higher on the banks. That's good news. Goldman Sachs, one of the keys in that investment services space, they reported earnings. We'll talk about that in a bit, but a nice positive reaction on Goldman Sachs. Same goes for Bank of America. Bank of America getting close to that early December high, up nicely, more than 7% today. And last night after the bell, United Continental reported its earnings, and UAL bouncing off of its support down near $78, having a really strong day today as well. All right, Erin, I hate to be the bearer of bad news, but I did see the Ducks went down for the 12th time last night.
I know. I can't believe it. And I'll tell you, the worst part is yesterday they traded away my husband's favorite player, one of mine too, Cogliano. He's like missed only one game in 6-7 years. He's like our workhorse, and they traded him away for a younger dude from Dallas. So that was just insult to injury to lose for the 12th time after that. So I don't know why they're scrambling players. They need to get rid of the coach, but hey, that's my opinion. And I'm not an expert.
Yeah. Well, I don't know what's going on with hockey, but I don't know. Hockey in Anaheim and hockey down in Florida, I mean, it just doesn't right to me. But
we have such an amazing culture of it down here. You wouldn't even believe it. Tons of kids teams, and the Ducks sponsor all kinds of ice rinks and uniforms. So it's I'm really impressed with the NHL. There's some good guys. They do some good things.
Well, we do have good news today because we have got a great guest back with us today, Dave Keller. And I gotta say, Dave, in addition to welcome back, I gotta say, why doesn't Cleveland have a hockey team?
No, we actually do. We have the Cleveland Monsters, which minor league hockey team for the Avalanche, and won the Calder Cup, which is the league championship 2 years ago, I want to say. So it's funny, when the Cavaliers won the NBA, the victory parade actually had the Cleveland Monsters in the front because they had won the championship as well. But I'm actually moving from Boston 2 years ago. I'm an original six Boston Bruins fan. So despite that, thank you for inviting me on the show again.
You got major league sports in baseball and basketball, and finally you got a major league sports team in football. Took a while, but you got one that actually wins now.
I was going to say, do they really have an?
Yeah, they do this year.
It's all relative, Erin, and now we've still plenty of upside, but yes, it's moving in the right direction. We like uptrends.
Yeah, absolutely. Don't we?
No doubt about it. Well, I know you're not here to talk sports with us today. I know you've got a very interesting concept regarding anchoring that you wrote about, and I know you're here to let everybody know some of the things that maybe we should be thinking about, because I told you before the show, I know I'm guilty of anchoring, and I think probably just about everybody watching is guilty to some degree. So we're really looking forward to your presentation today.
Sounds good. It's one of the more common behavioral biases, and we'll unpack it a little bit and talk about a couple ways to minimize how it impacts your decision. So look forward to the discussion.
All right, sounds good. Well, we're going to have you in here in about 15 minutes, but first, Erin, why don't you take it away, and what do we got coming up?
All right, the schedule. Tomorrow we have Julius de Kempenaar, Mr. RRG, will be coming in to talk with us. Mary Ellen McGonigal will be here for What's Hot, What's Not on Friday. And next week, Monday, there is no live shows because we don't have any live shows because of Martin Luther King Jr. Day, the holiday. So you'll just have to wait for us on Tuesday, and where I'll have my workshop, and I'll probably just continue on the technical building blocks where I left off on my last workshop before the holidays. So today, what's our exciting schedule? Well, as you just heard, David Keller is going to be here to talk about anchoring. Our first 10 and 10 symbol is going to be KTOS. And then our final segment is going to be technical scans. So I'll be sharing some of my scans, and Tom will be showing you how he scans. So it should be a great show today. Let's go ahead and get started, though, with technical news and headlines.
All right. Well, we are going to start it off with economic reports. We were expecting to get December retail sales this morning, along with retail sales less autos. But the government shutdown impacted that report, so it was not out. Kind of disappointing not having that report, because a lot of companies did come up with shortfalls, some disappointing Christmas sales, the holiday sales season. So this would have been a pretty big report, I think, for the market. But you can see the estimates there, but no actual numbers coming out anytime soon. As far as I know, November business inventory, same thing. Government shutdown. That particular report was impacted, so you can see the estimate there. We did get the January housing market index out at 10 a.m. this morning. 58 was the actual number, the market expecting 57. So a little bit of good news there for the housing market. And then 2 o'clock today, so in less than 2 hours, we will be getting the Beige Book. And if you're not familiar with the Beige Book, it is simply one of the Fed districts that reports back, gives some economic evidence of what's going on around the country. There are 12 Fed Reserve districts, so one of them will be reporting and just getting together and talking about what's been going on in the economy. So typically traders are pretty interested in that report. That will be coming out at 2 o'clock today. All right, let's take a look, see what's going on in terms of the 10-year Treasury yield. And I thought what I would do is bring up a little bit longer term chart. This is a 15-year weekly chart and supports what I believe was a turning point when we got the double bottom in 2012 and 2016. I think that intra-period high at about 3% in 2014, that was cleared when we got up to 3.25. I think that this signals the reversal of the downtrend. I do believe that the 10-year Treasury yield is in an uptrend longer term, even though we have been seeing it struggle over the course of the past few months. Could it turn here? Well, we had a double top at 260. We went down just below that level, and now we're starting to turn back up. But I think the series of higher highs and higher lows now is in play, at least intermediate, from an intermediate term perspective, with the high in 2017, the pullback, the next move to the upside, and now this pullback. We'll see if the 10-year Treasury yield can move higher. I know that there are a lot of market pundits out there that look at the higher Treasury yields and think, well, that's bad for the stock market. But as I've said on many occasions, the direction of the 10-year Treasury yield and the direction of the S&P 500 has a very strong positive correlation. So I think higher interest rates wouldn't necessarily be a bad thing. Okay, let's take a look at some of the earnings reports, because they are beginning to come out in droves. Last night after the bell, United Continental, UAL, beat expectations, and then you can see a slew coming out this morning. Bank of America, very strong report, getting a great reaction. U.S. Bancorp as well. Goldman Sachs, another company. I think Goldman Sachs, best performer in the Dow by a mile today, and also the best performer in the S&P 500 at last check. Charles Schwab, great report. PNC came in a little light. After the bell today, we will get CSX. Of course, that's a big railroad. We want to see what's going on there. Kinder Morgan and Alcoa will also be reporting after the bell today. And the number of reports coming out here over the next few weeks is just going to continue to escalate. We're getting some of the really big companies now, but we'll get that next tier, including a lot of the technology giants coming out over the next week or two. So we'll keep you posted on that. All right, let's take a look at some of these charts. I'm going to start with UAL. And with UAL, you can see the big move. I want to make sure I have the latest price here. And right now, the stock is at 86.04. It is up about 6% today, so very strong day. It was able to get back up above that 20-day moving average, which it's been trading below. And when I mentioned at the top of the show, it was bouncing off of 78 support. You can see this really quadruple bottom that was in play on UAL. Of course, I still want to see what happens with earnings, but the earnings did come out better than expected. We saw the gap up to the upside. You can see the volume today very heavy. We're not even to the halfway point of the day and already 6 million shares traded. So it looks like it could be maybe the highest volume day that we've seen since back in July on United Continental. So let's see how it finishes the day out. Okay, a couple other reports. Let's take a look at Bank of America, BAC, and the numbers here were very strong on Bank of America. We had revenue $22.89 billion versus $22.37 billion, and bottom line 70 cents versus 63 cents. Really nice move to the upside. We do have some serious overhead resistance that we're going to need to negotiate around $29. If you see a move above that intraday and a failure, we come back down and fail to hold it, that might signal a short-term top because we are getting overbought. As you can see, the RSI is the heaviest it's been since almost a year ago on Bank of America. So watch for a possible reversal at that key resistance level. Goldman Sachs, let's take a look here at the chart because Goldman Sachs making a really nice move. We are going to see a little bit of overhead resistance as we get closer to 200. I also would make sure that we don't get a reversal today. We wouldn't want to see a big long tail above the 50-day moving average with the failure to close, especially with all this volume coming in. The other thing that we want to watch are these 20-week moving averages. And with Goldman Sachs, check out where we are right now. Many times when you get the PPO declining like this on the weekly chart, and you get that rally and you test that 20-week moving average, that can be a very difficult area to pierce on a closing basis. So we want to make sure that Goldman Sachs is able to get through that level. That would certainly be a little bit more of a bullish technical signal. Speaking of these 20-week moving averages, let's go ahead and take a look at a couple of the major indices. So here's the S&P 500. We got through 2581. We've been talking about that. I've been talking about that endlessly. That was the double bottom. We had 2581 close. That was our lowest daily close in February. Same thing in April. Those were the lowest closes, and they both hit 2581. We broke down. We came right back up, though, and went through that level, and now we have the declining 20-week moving average, which we have not closed above since the first week of October. So the S&P is getting closer to that key moving average. I could go through the other major indices, but they're going to be the same. So let's move on and take a look at some of the sectors that we want to watch. The XLK, again, getting close to that 20-week, and you can see that has been a barrier for the bulls, haven't been able to get through. XLC, this is communication services, sitting right on that 20-week moving average. XLY, this has been one of the best areas of the market on a relative basis, holding up versus the S&P. But it, too, is sitting right at its 20-week moving average. You've got the XLF financials really rallying this week, but just beneath that 20-week moving average. And then we've got the XLI, also been in rally mode, but it, too, getting close to that 20-week moving average. I could pull up a lot of stocks, get into some of the FANG stocks. Here's Facebook, failing right now at the 20-week moving average. We'll see if we can get through. But there are some that have been performing pretty well. Netflix, obviously, with its strength, now well back above its 20-week moving average. So there are still positive stories out there. One last stock that I wanted to mention, talked about this in the past. You get these small biotech companies, in this case today, APTX, they had a major drug and it failed in one of its trials. And look at what happened to the stock. It was trading at $18 at yesterday's close. It's down 73% today. This is one of the warnings we talk about a lot. When you're in any of these individual small biotechs or pharmas where they're very dependent on one or maybe two drugs, you have to be very careful because their whole business can go down the tubes pretty quickly, or at least a good portion of it. And we saw that today with APTX. All right, Erin, upgrades, downgrades, what do you got?
All righty, let's get started. Today, actually, there were fewer upgrades than I've seen in a while. I picked out, of course, the interesting ones, and I'll list the other ones that we got. But here we are. Let's go ahead and get started. ING is the first upgrade. It was upgraded from a hold to a buy. And, you know, we're getting a little tiny breakout here. I drew this on the gap that's right here. You can barely see it from early December, and that matched up with the high here. And then it also matches up with a low back here in October. And you can see that we're now just barely getting past that. Now, if I look in the thumbnail too, I would look at this as right here, you can see there's that gap, another gap we had back here. And this looks like that island, an island reversal. We got the reversal, and now we got a breakaway gap, and looks like we're getting another gap here, maybe a runaway gap. So we'll have to see how this one continues, but we got the break above the 50-day EMA as well. So ING, I think it's looking pretty good. Makes sense that it got the upgrade. Southern Copper was upgraded today from a market perform to an outperform. And I moved this to a 6-month chart just so I could get a better look at what's going on here in the near term from the end of November to today. And you can see we had some support back here from November and December, matched up with the top we had back here at the end of December. All those lows, we dropped and closed below that area of support. But today it looks like we might be poking up back above it. So I'm thinking this is looking pretty good. The PMO had turned down when we were, we had the big decline. Actually, we were looking at some consolidation and it slowed down, but now it's heading right back up. And the big decline we had yesterday really didn't hurt the PMO much at all. So I think that's a positive. All right, I'll name off a few of our other upgrades for you. Annaly, Heineken, MetLife, Teladoc, Nutanix, Accenture, and Williams companies. All of those were also upgraded today. All right, let's look at a few downgrades. There we go. AK Steel was downgraded today from a buy to a neutral. And, it hit that overhead resistance in the shorter term and has started to head back down. And you have the next support level, I'd say, at about $2. Well, of course, that would be a huge move to the downside. But I think that we are vulnerable to that. Might be one of the reasons that we see this downgrade to a neutral. We've got a PMO that had the buy signal in very oversold territory, but you can see it looks like it's trying to decelerate on this consolidation that we're having. If we get the breakout, I'd feel really good about this one. But right now, we got to watch support. And if that breaks down, then yes, we might see a drop all the way down to $2. I mean, maybe a short opportunity. We'll see. Anheuser-Busch, Bud, this Bud's for you. There you go. I don't know that I want this Bud. We have a PMO that's turning down below the below the zero line. We had what I would call some pretty strong support. We got that breakout above it. It lined up with the gap somewhat here. And we got the breakout, looked like it was going to hold over the last few days, but we ended up with an island reversal again. And we're coming back down off of a gap now, moving lower. We're holding that 20-day EMA, but I don't have a whole lot of hope for this one. I would be looking for the $65 level. So more to consider. JW Nordstrom. Nordstrom was downgraded by 3 separate groups today. And I can understand why, although I didn't think it looked that bad until today. But 3 groups downgraded it, but they all downgraded it to a neutral. So we're not looking at, a serious shorting opportunity or anything here. But the chart, the technicals, we do have that downturn of the PMO below the zero line. Again, not something you want to see. And of course, the support level was broken, and it's pretty important support. It's really been the place for support really all year long, and we now have broken down below it. That's very bad news. And you have to go to a weekly chart just to see where the next area of support is. And you can see how that level was very important, and we lost that. So the next level down, I would be looking at, back to this low possibly back in 2016, which is 38. More likely, I'm looking at $36 where we had this low back in October of 2017. We've got some ground to cover here and moving down. Not looking too good here. Snap was downgraded today from an outperform to sector perform by RBC. This one's holding up now. We dropped and set a new low for the year, but we've managed to get back above the previous lows, and you can see all of those in November, October through December. And we did gap down on the downgrade today, but we're holding that support level. The PMO is turned down below the 0 line, which is expected given this big gap down. Keep an eye on it. I would be looking for the island, possible island reversal here, but a lot of that I think depends on the tech sector in general. I'm sorry, the communication services sector in general. It's been okay. If we can hold on to okay, this could be good. And, you know, we've got that support. Like I said, we've hit it. If we break down below it, watch for this. Maybe there's another opportunity here if it gets down to that $5 level. And other downgrades that I did not mention today: Allison Auto, Caesars, Devon Energy, Hewlett Packard, Insight, Network Appliance, PG&E got another downgrade today. Tech had got a downgrade, and Citigroup also got a downgrade today. That's all I have. And there you go. There they are. And it's time to bring you back, David. Are you ready to do our... I'm going to be looking in the chat room, guys, see if you have any questions for Dave as we're going along. But let's go ahead and get started.
Erin, thanks so much. I appreciate it. And Tom and Erin, listen, I will freely admit I don't listen to Market Watchers Live every day, but every day I do watch it. I wish I did watch it every day, because you guys do such a great job just recapping things from a technical perspective. It's such a great resource.
Oh, thank you.
Thank you.
Yeah, so thanks for what you guys do, and doing it consistently is so important, because there's plenty of traders and analysts that I know that, you know, go through the charts, but they don't do it systematically or with a disciplined approach, and you guys are there hitting it every day. So thanks so much. It's such a pleasure to watch this, and great to join you guys. What I was hoping to do today is basically talk about anchoring and explain what anchoring is. It's one of the more common behavioral biases, and I wrote an article on my column on StockCharts.com called The Mindful Investor. I wrote an article there yesterday talking about anchoring, and what I thought I would do today is just dig into a little more detail and unpack what anchoring is, why we're hardwired to make decisions based on mental anchors, and then talk about some of the ways that I've found over my career to minimize the impact of those anchors on your decisions. But first, there's a poll that we have going on for this segment, and it relates to the broad market. Tom and Erin and I were talking before the show about what we would want to ask all the viewers, and I was most interested selfishly in sort of where people were at. We've had, you know, an undeniable bear market in the fall of last year, and all of a sudden has reversed so quickly in such a dramatic fashion, and all of a sudden charts have gone from looking incredibly negative to incredibly positive so quickly. And so I'm very curious as to where people are at. So, you know, at this point, I think with a pattern of higher highs, higher lows, with all the charts that Tom was showing you earlier, you know, it's hard to say that we're anything but, you know, in an uptrend in the short term with this pattern of higher highs and higher lows. Over the longer term, I think you know, there's potentially some argument, but there's no denying the last, you know, 2-3 weeks have been fairly positive. So the question to all of you is, at what point, what would you need to see to turn negative or to turn bearish on the short-term market environment? What would make you start to question a bullish thesis here? And we gave you 5 choices. The first one is to fail at the 50-day moving average. And this is just a daily chart of the S&P 500. This is the daily chart that I've had up for a while. And again, the pink lines are sort of my own drawings, but we also have the 50 and 200-day moving averages and then RSI below here. So, you know, at this point, we've rallied up right up to the 50-day. So option one, first choice would be we fail at the 50-day. We're unable to eclipse it, much like we did here at the end of November, which resulted in a new move down. Would that convince you that the market's turning lower? Second would be a trend line break, which I've drawn a trend line using the December low that connects to the January low, that connects to the low we've had in the last couple days, and we've remained above this sort of general trend line. Would a break below that trend line convince you that the uptrend is over? And also, if you're familiar with Arthur Hill's work, which he does a fantastic job writing on StockCharts.com, you know, he talked about this bearish wedge pattern where you have you know, higher highs and higher lows, but in a converging pattern where they're sort of coming together. So if you draw a line up here, you can sort of see this wedge. If we break down there, that would violate the trend line and give a negative pattern. So option two, that would make you be negative. The third option would be a violation of the most recent swing low, right? So if you see this as a pattern of higher highs and higher lows, we start to break below some of these swing lows. We go to a new low on the daily chart. Would that convince you? Fourth option would be defensive rotation. So we've had this situation where, of offense to defense. This is the relative rotation graph that I'm sure many of you are familiar with. These are many of the defensive sectors: utilities, staples, healthcare, real estate. Here's our traditional offense: consumer discretionary, industrials, technology. Do we see enough of a rotation where the offensive sectors really start to appreciate and the defensive sectors continue lower? Is there something with the sector rotation that we convince you that we're now turning lower? And then option 5 is something I've not mentioned so far in the other camp. So I'd appreciate, while I sort of talk through anchoring, take a few moments and think through this chart of the S&P or whatever daily chart you have in mind. Think of those 5 choices and let us know where, at what point you would start to turn more negative on the market. And then at the end of my segment, we'll revisit that poll and see where we netted out. And then at that point, I will, not that I'll give the right answer, but I'll certainly give my take on how I would answer that question and why. So anchoring, I'm sure many of you are familiar with it. And if you're not familiar with what anchoring is, you will by the time we're done, because it's something that affects your decisions that you make day to day, and not just about your investment decisions, but about any decisions. When you go to buy some milk or refuel your car, or get in a relationship with another person, anchoring, part of that mental anchoring affects your decisions. And what anchoring is basically locking into a specific reference point that then affects your subsequent decisions. So there is something in your head, some experience, some item, some point of view that you anchor to, and then your subsequent decisions are related back to that initial anchor. Now, one of the examples that I'll share on anchoring is I used to teach technical analysis at the university level at Brandeis University on the west side of Boston. And I taught master's students, so it was MBAs and MSF students and masters in economics, and interesting group. And at the beginning of every semester, I would start to ask them about where they saw the market going through the course of the semester. And that would give us sort of a frequent discussion point at the beginning of every class during the course. Now, the one time I did it, what I actually did was I broke the class into 2 groups. And for the first group, I said, okay, where do you think the S&P will be at the end of, before our last class? And would just let them answer it. And I would gather all those responses. To the other group of students, I actually used an anchor. So what I did was I said, tell me where you think the S&P is going to be at the end of the semester. And I've surveyed earlier students, and their average response is around 2,100 or whatever level I threw out at the time. So the moment I did that, what happened was I anchored that second group of students to that price level, 2,100. And as a result, if they were going to say something really low, like 1,500, they would probably bump their response up a little bit because it was way too far from the anchor. It seemed way too out of normal. Same thing on the other side. If someone was super optimistic and was going to say S&P 3,000, the fact that I'd anchored them down, they go, okay, maybe I say more 2,700 or something. So the anchor that I gave them, by priming them with that first number, I was able to affect how they said. And as a group, the second group came out a little lower because they were anchored to a lower starting point. So that is a simple example of what anchoring is. Now, how is that actually reflected in our investment decisions? Well, this is a chart of Home Depot, just a daily chart looking at the last year. And again, not making any recommendation of what I'm seeing right now, but let's pretend, for example, that you bought Home Depot around 172, which is right about in the middle of this big open candle here at the beginning of January. Let's say you bought it right in the middle of that day. And so that price level of 172 is your buy point. What's happened when you have a buy point, and buy points, the entry points to a trade are one of the more common anchors that you will face, because what you've now done is you've mentally anchored to that price level. As long as Home Depot remains above 172, you have a certain feeling. But the moment it breaks below 172 and you're now at a loss, you start to have an emotional reaction. Even if you don't want to, you react to the fact that you're now in a losing position. You start to think about when you might want to reevaluate it. The reality is, even though that entry point of 172 has meaning to you because it's where you enter your position, the market as a whole could not care less about the fact that 172 means something to you, right? To the market as a whole, it means very little because it was just in the middle as one data point among millions of data points looking over this time period. So by anchoring to that point, all of a sudden you start making subsequent decisions related to that initial point. And at times you will make the wrong decision based on, what should be a pure look at the evidence. The trend is doing a certain thing. There's a breakout, there's a breakdown, there's a violation of a certain level. But by anchoring to that point, you're making an emotional decision based on your trade and your position, as opposed to just looking at the evidence and making a clean decision. Now, why would we anchor? Like, why does it even make sense that we would do that? It's clearly something we're hardwired into our brain. And I will tell you, I mentioned earlier, like if you're buying milk, right? So if you see that milk is trading for, $1.50 a gallon or some random number, right? The fact that you've bought milk before and you have a sense of what milk usually costs, you're able to make a judgment call as to whether milk is rich or cheap, right? Can I buy it for cheaper than I normally would, or is it really expensive? And by anchoring to that sort of average or to where you've bought milk before, it allows you to make a better decision about it. And not just with buying decisions, but with anything, that those anchors in some ways can actually be a good thing, because it allows you to make a value decision, make a judgment call, evaluation based on prior evidence. But why do we actually do that? So what I've read and what I've learned is that anchoring is a hardwired thing which allows us to make sense of a very chaotic world, right? If we weren't able to anchor on some value, the numbers of people and experiences and their faces and what they're doing and all of the stuff happening around you, you are one piece of a huge, operation in your city, in your country, in your world. And if we didn't have some sort of mental anchors to make sense of that, it would be incredibly overwhelming. I think we wouldn't be able to make any decisions at all. So we do it as a way to make sense of what's happening around us. We do it to have some frame of reference, that we're not just making a random decision based on random data. We're able to compare data back to a starting point that has meaning to us. So in general, is being aware of your buy point a good thing? I would argue yes. Does it help you to make better decisions? Well, I would say this, right? So if I asked all of you how many stars there are in the universe, right? You probably have absolutely no idea unless you're an astronomer, which I'd assume most of you are not. So if I said how many stars in the universe, we would get some completely random numbers. And I asked my 11-year-old daughter how many stars she thought there were in the universe. And I think she said 100,000, which good guess, Zoe, but that's not true. So what if I anchored you to a starting point and I said, how many stars are there in our entire universe? But in our galaxy, which is just our little piece of the universe, there's about 100 billion stars. So it's got to be way more than that, because there are millions and millions of galaxies. All of a sudden, I've anchored you to a number that makes a lot more sense. So it would allow you to make a much more informed call. So my point being, anchoring is where you are primed with some starting point. Anchors in general prevent you from making good decisions with your investments, which we'll get to, because what happens is you don't want to be anchoring to a point that's not meaningful. There are times when it can be helpful, and I would say from a money management standpoint, anchoring to a point, especially where you feel like you need to make a change in positioning, can be very good. But in general, we're going to talk about how to minimize anchors. So let's talk about this chart of Home Depot, and we'll talk about a couple different things. There's 3 ways that we can, in my opinion, that I've learned that you can minimize the impact of anchoring. The first one is and in general, what we want to do is disorient ourselves and focus on the evidence. So number one, we want to disorient ourselves. We want to unplug from the anchor. We want to forget that on this chart of Home Depot, that 172 is meaningful to us. We just want to look at the chart and look at the evidence itself. And by focusing on the evidence, then we're able to analyze the trends, analyze the price movements, analyze the supporting evidence of oscillators, relative performance, whatever else. But we're doing it from a clean slate. We are starting fresh. And then we can compare our analysis back to our positioning, back to our, use our money management skills to combine our analysis back to our positioning and where we want to go. So 3 things that I can suggest that will allow you to minimize the impact of anchoring. The number one, and it's so simple, and I can't show you because I'm literally holding my hand over my screen. The first step is to cover up the ticker. And this seems juvenile and not a very technically oriented one, which is totally fair, but it'll work. So what happens is up here in the upper left corner, I can see that this stock is Home Depot. So when I'm looking at the chart, I want to look at the price. I want to look at the trends. I want to look at the price patterns. I want to look at Dow theory. I want to look at oscillators. But I don't want to make a judgment based on the fact that this stock is Home Depot. Because the moment I think of this not as a price series, but as a chart of Home Depot, I am now anchoring to some prior experience I've had with Home Depot. I will remember the time that I bought Home Depot and it rallied and made me a ton of money when it was my best performer. I may remember a time when I was on the wrong side of it. For example, if you owned it, in late September, right before it fell off a cliff and you held on too long, those experiences are now going to anchor, and you will anchor to them, and it will affect your ability to make a good decision now on Home Depot. What you want to do is start from scratch and say, right now, if I had new money, would I buy a Home Depot today? And if the answer is yes, then you want to compare it to how you're positioned and see, are you reflecting that in your positioning? So literally what I would do is cover up the tickers. And the great thing about StockCharts, it's right here in the upper left corner. You cover it with your hand and you can easily go through it. I've also copy and pasted things in documents and put, covered up the tickers with some object or something, which is totally fine. But as a quick thing, just cover up the ticker and just do the analysis. Forget what the company is, forget what sector it is, and just look at the chart itself. Now, in general, I would say with each of these three tricks I'm going to tell you, over time, what I found working with technical analysts for my career is the best technical analysts, the seasoned pros who have been doing this and have a really good process, they don't need to cover up the tickers anymore because they're able to look at the chart and not be influenced or biased by some anchors or minimally so. But as you're getting started, as you're getting comfortable with going through charts like this, covering up the tickers is a great way to just forget about what the stock is and just look at the chart itself and focus on the price movements. So the first trick, just cover the tickers or forget what the ticker is. The second trick is to invert the chart. Okay, so we're gonna switch gears to Apple, which I'm sure many of you know. So this is a chart of Apple looking at the last 1 year. So this is a trick that I've learned using StockCharts.com for a while. Many of you, or some of you may not know, if you add a minus sign in front of any ticker, it'll quickly invert the chart. Super simple way to just, shake it up a little bit. As I mentioned, disorient yourself, start from a clean slate. So now forget what this stock is, forget that it's Apple, forget what it's doing, and just look at the prices itself. What do you see with this price? Well, again, I'm just going to do a quick, simple Dow theory analysis. Do we see higher highs and higher lows? Absolutely. We see a clear pattern of higher highs. We see a clear pattern of higher lows. I don't see a violation of support yet. It's actually holding up on support around this level here. So overall, would I rather own the stock or not own the stock? Again, based purely on that simplistic analysis, I would think this is a good long idea with a pattern of higher highs and higher lows, and it's pulled back to a potentially good buying point. Now we compare that back to what this actually is. All right, this is an inverted chart of Apple. So what I've basically said is if this is a great long idea, then this should probably not be a long idea if I look at the regular chart of Apple, right? If the inverted chart looks so good, by definition, the regular chart looks kind of bad because it's a pattern of lower lows and lower highs, and we're right at resistance and we haven't broken it yet. So, and again, this is not designed to be an Apple call, but more designed to illustrate the point, which is just by inverting the chart, you will start to see things that you wouldn't see otherwise. But, if you remember, those of you that in kindergarten or preschool or something like that, one of the things I remember doing is tracing a picture of an elephant, but they turned the picture of the elephant over. And so you're just tracing lines. You're no longer tracing an elephant, you're tracing lines. And when you trace the picture of the elephant right side up, you actually did worse because you saw it was an elephant. You're trying to draw the trunk just right and everything and the legs and all of that. But when they inverted the picture and you're just tracing lines, everyone's picture looked way better because all of a sudden you're just drawing lines on a page. You weren't worried about the fact that it was an elephant. You disoriented yourself from the visual image and focused just on the lines that you were drawing. And that's what we're doing here. We're inverting the chart. We're disconnecting from the fact that this is a company that we know with products that we may use and a stock that we're familiar with, and we're just looking at the prices and the trends. Then from there, again, I would always go back and then think about the fundamental stories of Apple and the product line and the projections and all of that. But just for the pure chart read, you can disconnect from some anchors just by inverting the chart and starting from scratch. The third thing that I would suggest is to remove the price. So what we do here, I actually have a chart style that I've created, and then I'll explain to you what I did to create it. Whoops, I actually didn't do it here. Hold on. So we will take this down, and here we go. So this is now a chart, and I've eliminated the price. I am looking at two moving averages, I'm looking at RSI, and I'm looking at the relative performance. So forgetting about the chart, forgetting about the stock, forgetting about the noise, let's just look at the trend. Well, the 200-day moving average has been sloping higher for much of the last year, much less 12 months, but starting in December, it started to slope downward. So I can assume, based on the fact that that moving average has transitioned from bullish to a bearish phase, that this stock is now in a downtrend of some sort after being in a long-term uptrend. This is the 50-day moving average. The fact that it rallied up, I can assume that this stock had a really good movement through the end of the summer, beginning of the fall, but then turned down very quickly. And now I would assume it's at the lower point because the 50-day is below the 200-day and they're both sloping downward. So overall, this is stock that's been in an uptrend, but it now has come down a little bit. The RSI tells me that the stock has probably bottomed out recently and has rallied just a little bit off the lows by the fact that it's oversold. I had this higher low and now it's broken to new highs. But overall, the stock is still not in a good relative position because it's been underperforming pretty consistently for the last 6 weeks, right? So all of that analysis I did without looking at the price itself. I just looked at the moving averages. So I just looked more at the long-term trend. And then I looked at some of the supporting evidence, what I would call the confirmation, using things like RSI, the relative performance, and so forth. By eliminating the price, all you're doing is eliminating the noise. You still understand what the trend has been, but you're not starting to get biased by some of those short-term movements. Now, would I ever suggest that you buy or sell a stock without looking at the price? Absolutely not. This is not the answer to the question. This is the beginning of an exploration of a stock and a trend, right? So you start with this sort of thing just so you're not too biased by the price movements, because the more you look at charts, the more you will recognize the chart of Apple the moment it comes up because you've seen it a lot. You just want to look at the trend and answer it like you would a checklist before you start an airplane. Here's what the moving averages are telling me. Here's what RSI is telling me. Here's what the relative performance is telling me. At the end, what is the mosaic overall? What is my overall picture on the stock? And then you add the price back in, and then you start to make some assumptions on it. So this last one may be less familiar with you for some of you. So I'll show you, a friend of mine showed me how to do this earlier, and I think it's fantastic. So there are two things you would want to do. The first is there's this, you want to make it less opaque. You want to make it basically transparent. So on average, this setting is at 1, and you want to take it down to 0, which basically means make it, eliminate it. I'm no longer going to see the level. And then there's also these y-axis labels, which I would take off. Because all that does is when you have the y-axis label, it's going to start anchoring you to some price level that you see on there, and it's going to tell you where the price is, and you don't want any of that. So if you deselect that, change the setting down to 0, it will remove the price. And so I've created a template that just eliminates those quickly in case I would want to do it. Now I can add the price back in, and now all of the analysis I do on the individual price bars, on the candles, on the short-term candle patterns, on the gaps, all those tactical things that are really helpful, I'm now doing it within the framework of a trend and a framework of, not being biased by some of the price movements I may have been familiar with or anchored to before. So the 3 ways we can minimize anchoring: number 1, cover up the tickers; number 2, invert the chart by adding the little minus sign before any ticker; and the third thing is just remove the price altogether. Take the price out by making it less opaque, like you have the setting here, and just look at the trends. And again, these are just some of the indicators that I use. This is a great opportunity to add a couple more indicators on there and just look at the overall picture. Look at each piece of evidence and figure out what you're seeing. So as a closing thought on anchoring, I would remind you that anchoring is not always a bad thing. And I've actually had, I will tell you, nobody's perfect. I've had plenty of arguments with other behavioral finance aficionados, some of my peers around the industry and in academia, about anchoring and whether or not it can be a good thing. I tend to think it can, because I would say when you anchor to something and it allows you to make a better decision, make a decision that will be a good value decision, for example, I think it can be helpful. The problem is a lot of times we do, undisciplined anchoring. We anchor to something we don't realize it's happening, and as a result, it affects our ability to analyze the evidence from a pure standpoint. So, where is it a good thing from a technical perspective? I think, being familiar with your buy points and at what level you would reconsider your positioning, I think can be a really important anchor to be familiar with. So again, I am not long Apple or recommending it, but let's just say, for example, that I bought Apple right here when we pulled back to 150, and now I'm in the short term happy with that movement, for example. One of the things I would remind all of you, and Tom and Erin are doing a great job of showing some of these things. I've always said to treat your charts like a workbook. Don't treat it like a painting. So you don't want your charts to be some pristine thing that you never touch, that you're hanging up on the wall, and there it is, this beautiful, clean view. I would treat your charts like a workbook. This is a way to capture what you're thinking and what you're seeing and at what price levels you think you want to revisit something. That's really, really important. So at this point, I've drawn a line at the point where I bought the stock theoretically. So I'm always now looking at where this price is relative to my buy points. And I might want to put a comment in here so I can remind myself, bought X at something. And just so I remember what I was thinking at a certain day, I might want to put the date in there as well. And then you can save these charts in a chart list. So I have a chart list called brokerage. I have a chart list called long ideas and any other things. And when I actually put a position on, I put notations on, I save the charts, and I put them in there as a way to remember levels that are really meaningful to me. And then as the price goes on, as the future goes on, you can see how the price moves relative to those important levels that are of interest to you. So my final thought to you on anchoring is treat your charts like a workbook. Don't treat them like a painting. So at this point, if it's okay, that's my presentation on anchoring. I would love to revisit and see the results of the poll and talk about where everyone thought that we're headed, and of course answer any questions that might have come through the chat room.
Yeah. Go ahead.
Go ahead, Erin.
I did get one from the chat room. I just noticed. The person is wondering whether this works for day trading or momentum trading, and like any stocks and an ETF. I mean, that's, I guess, what the question was.
Yeah, good point. So the answer is it pretty much works for everything. We make these decisions using anchors for pretty much everything, and so it's anything with, from a technical perspective, anything with price allows you to do some of these techniques, to be honest with you. And so a lot of times what I would suggest is use ETFs, because you can find an ETF that tracks pretty much anything, a sector, an industry group, a commodity, a currency, the dollar, interest rates. And by doing those things, inverting it, flipping it over, covering the ticker, all it does is it just removes what it is and just focus on the trend. So it could work for anything. In terms of timeframes, I say it's all, your charts always want to reflect your investment horizon, right? So I tend to be thinking out on average, I'm looking, 3, 6, 12 months down the road when I'm looking at charts, which means I'm looking at a lot of weekly charts, 5-year timeframes to start with, because that's the amount of time I would want to start with to project out that further. But if you're looking at the next couple days, I would say you want to be looking at a shorter term chart, like a 6-month daily chart, and applying these techniques we've talked about, but just looking at the swings on the shorter term time frame. Same thing with intraday data, all of that. It all comes back to whatever's a meaningful time frame for you.
Hey, Dave, it was a revelation while you were going through this whole thing. I realized now that if I went back and I put a minus sign before all the stocks that I traded in the fourth quarter, I had a much better return.
Yeah, that's never a good feeling when you invert all your holdings and you get really excited. So that's a good lesson, Tom. That's
yeah,
true.
Some of the stocks I thought really look good, they do, but just inverted.
And it's funny that the tricks that I've talked about, it's such a simple thing, but a lot of the bias, a lot of the challenges we face is just visually we'll be primed for something. So another common thing I've always said is never confuse the bottom of the page with support. So just because the price has gone down to the bottom of your chart doesn't mean it can't go a lot lower. And look at charts like Crocs or GE or any of those stocks that have gone down in a meaningful way, and you'll see what that means. So by inverting it, you just disorient yourself that okay, now it's at the high point. Okay, what does that mean? And yeah, but yes, if you get that sort of ecstatic feeling inverting your charts, you want to revisit your positioning, Tom, for sure.
All right, now I do have a question on anchoring though, because when I look at the results to the poll, I'm wondering if I'm somewhat anchored because I believe that in the short term the market needs to roll over, and I do look at certain levels. I mean, I've been talking on Market Watchers Live now probably for the last few weeks about 25.81. That was a key support level on the way down. And now it's, the market's reversed and it's gone back up, and we see the S&P now a little bit above that 25.81 level. And I do find myself continually thinking that, hey, maybe if we get back down below that 25.81 level, we're going to see those sellers start to kick back in. So I guess a couple of questions. Number one is this anchoring isn't necessarily just about individual stocks, but it could be your view of the overall market, number one. And then number two, when you're buying or selling stocks, or let's say you're looking to enter stocks and you really don't want to get attached to a particular price, for you personally, if you're going to look to buy stocks, do you start with a scan of some sort with maybe a trend, maybe a short-term moving average crossing a longer-term moving average? Or how do you go about buying stocks if you're just simply trying to get past certain price points?
Great. Two really, really good questions, Tom. So in answer to your second question about how scanning or how you try to disconnect from prices, I would say that it's really, especially nowadays with decimalization and stocks trading at sub-decimals and the volatility that we're having, it's very difficult to focus on a specific price level and expect it to be a hard ceiling or a hard floor. So I have found, and now if this was 1992 and stocks are trading in 8s or 16s, then you actually could expect that a stock hits a certain level and reverses because there's limited points it can be, but that's kind of behind us. So I tend to screen less on individual price levels and focus more on meaningful signals that would inform me as to a change in price. So things like moving averages, MACD is a common screening tool I'll use, or PPO, something that's just, something that's been in one phase and now it's turning. Now the price levels and all of that will be reflected in the chart, but it's easier to screen on a larger universe by using something like some trend-oriented technique. The other thing I would say is when you're looking at individual stocks, I've always found that instead of thinking of a specific price level and consistently checking the chart for a certain level, all of a sudden the more you look for that price level keeps getting banged into your head over and over, and all of a sudden it means more than it should. So I would always set a price alert and then forget it, and then just it'll tell you when you need to start worrying about it. You don't have to think about the price level anymore. So those are two things I would say in terms of scanning and on individual names. On your first question, I would say, you bring up a really good point, which is, does anchoring affect your, overall market decision, right? Or you anchor to a certain idea and then that affects your decision. So I would say that what you described to me sounds less like anchoring and sounds more like confirmation bias, which brings up the really meaningful point that any of these behavioral biases that we talk about, they don't happen in a vacuum. And you are affected by a lot of different things that you read and that you see and that you hear, and just your own mental programming that affects your decision. So, confirmation bias is when you mentally think I'm bearish, and then all the charts you look at, you're just looking for evidence to support that bearish claim. And if you see something that's bullish, you kind of push that to the side mentally because you just want to validate your own opinion. In general, we tend to use these together. So you're anchored to you're trying to confirm some preconceived market opinion. You're bearish, so you're looking for bearish evidence. But then you also anchored to some price level that all of a sudden affects your something that triggers that level. You're like, okay, great. Now that's a piece of evidence. So it absolutely is related, and I would say definitely affects what you're going to see with the broad market. And of course, even though that is how we're wired, you want to do that as little as possible. You want to focus just on the evidence. And so I have always coached people just getting started, make a list, handwritten list. Here's what I'm seeing from all these different points, these different data points, and then look at it all together and evaluate where you want to be.
Okay, fair enough. I know looking at the poll here, I could probably answer, and maybe everyone out there thinking the same thing, I probably could answer a couple of these. So I kind of looked at it as to which one would be more meaningful to me. And I know for me, I went with the break of the trend line, support, and the wedge.
Yes. It's interesting. I'm actually surprised how much everyone's grouped onto the failure at the 50-day. If you think about each of these things, the failure at the 50-day is one of the more leading indicators, right? That would sort of be the beginning of the move, whereas a break to a new low or the break of the trend line would be more of a confirmational move. That's something that would happen after we sell off a little bit further. So it's interesting that what that tells me, and I am totally on board, the fact that we've rallied so quickly, the V bottom out of the lows, and now, I mean, you showed some of the banks actually rallying after they've been so bad for so long. Boy, it feels like this has been so quick, and some stocks are becoming overbought in the short term, which, you're just looking, it's going to take one bad day to all of a sudden make it look a lot less attractive than it has. So I'm not surprised people are saying that. It tells me that, we're all sort of waiting for some signal that tells us that this uptrend is not just going to go straight up to S&P 3000, which I certainly don't think is going to happen. All else being equal, Tom, I'm sort of in your camp. I would look at a break of the trend line as being really key. And depending on how you drove that trend line out of the lows, we either just broke below it or have just retested it. And until we get a confirmation below there, by definition, the trend is up. So the way I'm seeing it is as long as we stay above that trend line of the lows, the trend is positive, especially the short-term trend. But long-term, overall, I think with the negative breadth that we have seen from a longer-term basis, the rotation to defensive sectors that would take a lot to kind of reverse, I feel like there's still more backing and filling we would need to see from a longer-term perspective before I could get really bullish in the long term. But great. Thanks everyone for answering that. It's really interesting.
Yeah. I know looking at the market, I think most technicians, we're not used to seeing too many V bottoms, especially when the market sold off on such heavy volume at the end of the year, which normally, by the way, December is a very bullish historical month, and December was just horrible. And now we've got this huge move to the upside. So is there a point, or is there something that you're looking for that would suggest to you that we're not going to go back down and retest those lows? Because I think most technicians would expect at least a retest of what we saw in December. But as it keeps going higher, I'm sure everybody thinks this way. When do you say, you know what, maybe we're not going to go back down there? Is there something that you're looking at there?
It's a really good question. So in my opinion, I think getting to the defensive sector leadership you talked about, I think that if you see a rotation away from defensive sectors, a rotation more to offense, which would be driven, it appears to be, driven by things like, Amazon and Netflix, which, charts that had looked really bad not too long ago, a couple weeks later, all of a sudden are breaking out of these congestion patterns. So, leadership from some of the traditional leadership spaces, financials recovering. I mean, if that is a trend that continues, it would be really hard to stay, to expect a lot of downside if you really see meaningful movements. From a broad market perspective, it's all about, in my opinion, at some point we correct, right? We have to. We're not just going to go straight up. At some point we correct, and where that correction goes to, I think will be the most important thing. So if we start to hold previous support levels, right? More recently on the S&P, that would tell me another higher low here, and especially on the weekly chart, if you'd see a higher low, which we haven't really seen yet, that would, for me, tell me to be, to be less negative and maybe expect at the very least more of a sideways kind of choppy market. And then broadly speaking, right, 2,700 is the midpoint of that symmetrical triangle from the first half of 2018. If we get meaningfully above 2,700, and this is more of a trend following take. If we break above 2,800, which is the ultimate sort of line in the sand, then I don't see how you could be negative. You have to be, pretty bulled up at that point, in my opinion.
Okay, fair enough. Well, I certainly appreciate you coming on here. It's always great to hear from you, and I think it gives everybody a little different perspective on how maybe to take a look at these charts and to try and get away from some of these biases and anchoring and so forth that I think everybody's guilty of.
Absolutely. Yeah, appreciate it. Always a pleasure to join you guys. Thanks, Tom and Erin.
Yeah.
Appreciate you coming by, and we'll definitely have you back. Also, I want to just let everybody know that Dave does write a blog at StockCharts. It's called The Mindful Investor, so you can go in and check that out at any point. But always a pleasure having Dave on with us. All right, Erin, we spent a little bit of time there, but I thought it was a great conversation. Let's go ahead and jump into the 10 and 10. Do you have an RRG?
I absolutely do have an RRG. Let's see. First, I'm looking at my S&P 500 chart here. I didn't get to weigh in, so I'm going to tell you what I think.
Oh, what do you think?
Well, I answered the wedge failing, but I was looking at it, and I think we probably will get even higher. I'm looking for a failure at this declining tops trend line, because that would tell me that, if we get up above that trend line, then the declining trend in the intermediate term has been broken. Mm-hmm. So that would be my, my point of, okay, I need to start looking for this as that we're going to go even higher. But for my taste, I'm still looking at that 2,600 level. That would, of course, get us that breakdown out of the wedge. And then, of course, the measurement here is pretty ugly, guys. That would mean certainly quite a decline.
Yep. And that level would almost coincide with the 20-week EMA, which is up at about 2670, 2660, 2670 area. So,
yep.
It's difficult watching the market go back up because I haven't done anything on the long side in a while, but we'll see.
Yeah, I don't like it, but honestly, it's so much less painful than watching it go down and holding a lot of stuff. I have to say, it's no fun, but not that bad. All right, RRG here.
This is going to be a record. We're going to go through. This is going to be a record getting through the 10 and 10, I promise.
Check it out. Technology. Definitely what everybody wants to see. So I'll definitely throw some technology stocks in there. But our first one is an industrial, right? KTOS. KTOS.
All right, let's take a look. Kratos Defense and Security Solutions. I think it's pretty obvious there are a couple key levels of price resistance you want to keep an eye on. On a relative basis, we've seen some wild swings on the stock, but on a relative basis, I think this has held up pretty well. I know a lot of the defense stocks struggled in the fourth quarter along with the overall market, and this one held up, I think, fairly well. But it is at a key level where we've seen a lot of failures coming across here near the $15 level. And so far today, I don't like that candle. That is a dark cloud cover candle. A little bit more selling. We'd have a bearish engulfing candle, and off of a top, or excuse me, off of a an uptrend and at a major resistance level, that could be problematic. Let's see how it closes today. But if it doesn't finish strong, to me, this looks like a topping area on the stock, at least short term.
All right. Interestingly, and it just flipped, our most popular in the chat room is the materials sector spider, XBI.
All right. It's funny. I talked about the materials a little bit. XBI, well, this is actually biotech.
Oh, yeah, I'm sorry. Duh. It's XBI.
Okay, because, yeah, I looked at the XLB, which is the materials ETF, in my blog article this morning. I think that this is a key area. I don't like this reversing candle here because it is getting close to a major overhead price resistance level on the biotechs. I think it's pretty clear with the last couple of tops. We've actually had 3 tops up at about 85, just above 85. Today's high was 83.97. So we're getting close. And when you consider we were just down at 65 3 weeks ago, we're pretty darn close to that overhead resistance level. So I'd be tempted to take some profits in biotechs if I was long and see if the overall group can break out. If it can't and it starts to move lower, then I think you got to be looking at that 20-day moving average as we go forward.
All right, let's see. The other most popular, I thought I'd throw this in here because it almost was the number one. SH.
Yeah, we've taken a look at this quite a bit. I think 30, as I've mentioned, is probably the best reward to risk entry into the SH. Now, again, the SH, you are shorting the S&P 500 when you buy the SH. So this goes higher when the S&P 500 goes lower. So this whole rally that we've seen in the S&P 500, SH has been under steady decline. But this is the area where we broke out on the SH. And of course, we're coming back up and testing essentially the area where we broke down on the S&P 500. So I think that the reward to risk on the SH, I like it here at this level. But I think if the S&P 500 were to close out a week above that 20-week moving average, I think I'd have to be moving back to the sidelines. I would not hold a short in a secular bull market for a long period of time if it starts to break out, goes against what we're looking for.
All right. Let's see, the next one I'm going to give you is Etsy.
Yeah, this is in the consumer discretionary space, which has been so strong, and I think Etsy's been a great performer. It is nearing overhead resistance. I think it's still on a relative basis when we compare it to the overall market, the S&P. We take a look at it versus the consumer discretionary space. Every way you look at Etsy, it's been a really nice performer and a huge move off of this double bottom down around 42. So at least from as long as we stay in this volatile market, if we start to roll over, I think you've got to recognize the range here. But I think what I would probably do if I was in it on the long side is maybe keep an eye on this trend line, because as long as this trend line holds here, I'd probably hang on. But the moment it breaks down, if it breaks the trend line and that 20-day moving average, I think it's starting to point maybe to a pretty weak market, and Etsy maybe going back down toward that double bottom. So I would just keep my stops in play. And as it gets closer to 57.5, I'd probably be out of it anyway, just to see if it can break through.
All right. Let's see. Next one I will give you is Anglo Gold Ashanti, AU, a gold miner.
Yeah, I think that this group is probably just taking a pause while the market continues moving higher. I think the key here on this stock was the negative divergence that I saw. So here you've got your higher prices, and you can see that the PPO is rolling over. So that tells me that maybe we're going to get a 50-period test. I'd be looking maybe at this recent low down around 1175. I think maybe what happens is price action just simply moves lower while the 50 rises, and maybe we get that 50-day test close to the 1175 area.
All right, let's see. Next one. I'm sorry, I just loved the name of this one, so I had to I had to do it. It's SDOG, SDOG, and it's the Sector Dividend Dogs ETF, which is funny because I'm going to show off my scan for dogs.
Yeah, it looks like it's just, similar to the overall market. I mean, it's making its way back up into this range of prior support that was lost in the middle part of December. Here was the big selling, heavy volume, and here we are back up into this range. You can see that the PPO also very close to the center line. So a lot of times when you're in a bear market, you get to the center line. A lot of times you will roll over, and we've seen that on a few occasions here in the fourth quarter, and now we'll see whether or not it happens again here. I'd be careful until we get a break above that 50-day. So this is an area that I would actually be probably selling and taking profits if I was in SDOG.
All right. Next one up, PBR.
Is that the beer?
Nope.
I figured it wasn't.
You wouldn't want to drink this one.
No, definitely wouldn't want to do that. Nice move up here. Good volume coming in too, which I like. So the fact that the volume trends have turned more positive makes me think that it's probably going to hold that rising 20-day moving average on the pullback. So I think, first of all, you've got resistance overhead here. That was about 1510. We're testing that. But then even if we were to drop a little bit lower, I like the fact that this one's got the rising 20-day down at 1450. I think any kind of a test of the 20-day would be something I would consider on the long side here.
All right, perfect. Cisco, CSCO.
All right, as opposed to the food Cisco.
Right.
All right, let's see, CSCO. Yeah, it's probably, I would say it's not acting as well as some of the other companies. I mean, we're barely above the high we saw a week ago, while many of the other stocks, tech stocks have done much better on a relative basis. I think the 50-day moving average is going to be worth watching here. We are above the breakdown level, so I guess that is a positive. If you take a look here, you can see that was a prior high. When we gapped up, we went back down, essentially put in a double, almost triple bottom at about 43 before we broke down, or 43 and a half, I should say. And now we've gotten back up above it. So what I would be looking for maybe is if we were to lose the prior low, the recent low at 43, I think that would be a bad signal. So as long as Cisco can stay above 43, I'd be okay with it. The other thing that I just talked about, you can see this reaction high that came in here just above 44 and a half. That's pretty close to that 50-day moving average. So I think we're trapped right now in Cisco in that fairly narrow range.
All right. Kemet, KEM.
All right, KEM. On a relative basis, not really holding up, and the strength here has not been on very good volume. I'm not feeling very good about this stock. You do have some price support that has been holding in at about just below $16, but you've got this downtrend in play. I think eventually the stock is going to break back down. So on this rally and getting the PPO back close to the center line, to me, it's a sell. Now, we are still holding the 20-day, so maybe you just give it that little bit of room, and if it closes back below the 20-day, exit. But I would be careful. I don't like the way this one's trading.
Okay. And finally, Dropbox, DBX. That should be the last one.
Yep, number 10, DBX. Another one that's really, I don't know, the overall trend continues to be down. I'm not seeing any kind of major accumulation based on volume. So we were oversold, we bounced, but I don't think we get back up above the reaction highs from second week of December, maybe late November. So on the chart, I would just simply draw two resistance lines, and that is where I think that the stock is going to really struggle to try to get through. So I personally would pass on it. I think there are better options out there.
All right. That does complete the 10 and 10. And here are our symbols. Just go to the Market Watchers Live blog, blogs tab, and then select the Market Watchers Live blog. You'll find the link at the top, or they are in every Market Watchers recap as well. All right, time for our final market update. Let's go ahead and see what has been going on while we've been having fun. At least I hope everybody's been having fun. All right, here we go. As you can see, we hit intraday highs for the large cap indexes earlier this morning. And now we're pulling back somewhat, or if you want to call it consolidating. Mid caps are forming a symmetrical triangle for sure here. You could spot that from a mile away. Those are continuation patterns. So actually what we should expect in the very near term or during the day even would be a breakout to the upside out of that particular triangle. Right now, Russell 2000 again hit intraday highs, has pulled back, but seems to be consolidating sideways slightly. TSX, same. We can see that the Treasury yield, although it gapped up at the beginning, 10-year Treasury yield is currently at 2.722. The VIX is almost unchanged. Currently, we're getting a reading of 1867. UUP, the dollar, consolidating sideways, but up a little over 3 cents. Gold, GLD, has hit an intraday high. It does look like it's pulling back now, but it is still up 40 cents, reading 122.28 for GLD. USO is down slightly, kind of a volatile day of trading at this point, currently down just under 0.5%, reading 10.95. And TLT, big gap down this morning, but has been making its way back up. It covered all those losses and now is continuing higher and is now challenging yesterday's intraday high. And that's all I have for the final market update. I'm going to pass it back to you, Tom.
All right, this is just a chart of the spider over the last 4 months. And I just wanted to point out that during this uptrend, you can see there were only two filled candles, meaning that you closed above the open on just about every candle in this uptrend. So that's a sign of continuing push to the upside, accumulation, that sort of thing. When you look at the downtrend, the exact opposite was true. In December, we only had 2 hollow candles. Most of these were filled candles. One of the things that I'm looking for and waiting for in the market to get a little bit more aggressive or to get aggressive on the short side potentially is a weak close in the market. We have been finishing at or near the highs just about every day, except maybe 2 throughout this uptrend. So a weak finish is another thing. A weak daily finish is another thing maybe we could have added to the poll to see some sort of reversal, maybe a little bit of impulsive movement to the downside. So right now, still not seeing anything like that, but that's one thing maybe to look for in the days ahead.
All right. Very interesting stuff. Technical scans. Do you want me to start or are you going to go?
Go right ahead.
All right, let's go ahead. So I thought today I'd just share some of my favorite scans that I have. A lot of you have seen them, but I wanted to go over them again. These are my advanced scans, and I have posted most of these I think I've posted all of them in various blogs. Maybe today I'll just put all 3 of them in the Market Watchers Live recap. And then if you are an extra member or above, you can copy this code and then just put it in your own scan and save it as you wish. And of course, you can also manipulate it as well. So I think we're in a bear market. So I would be looking for dogs more than, meaning I would be looking for shorting opportunities before I would be looking at long opportunities. And so that's what this particular scan will do for me. It shows me stocks that rather than look like they're on the upswing, look like they are on the downswing, and they're already in a negative situation. So I've got my groups here. I am going to add some. So I'll just type these in, and you can do the same, obviously. Let's add the S&P 600. That way we can get a few small caps in there, and we're going to add the S&P 400 as well. Oops, I forgot the is, so I know it's going to tell me it is not the right code. And then when you add anything, you want to check the syntax just to make sure. I did catch that one, but you might not. All right, so I'm going to look, this is my universe. I'm going to look at the S&P 500, NASDAQ 600, and 400. And what I'm looking for is today's PMO line, or the most recent, because I'm looking at an intraday update. I want to see a new crossover, basically. That's what's going on here. And I need to probably update the language here, because I think all I need is an X right there. But I did this before. I mean, I've had this for a long, long time. I'm also looking that the PMO line has been moving downward the day before. So it's on a downswing, momentum is moving lower. And then I want to have the 20-day EMA below the 50, and especially I want the 50-day to be below the 200-day, because as I often say, for decision point, we consider a stock, ETF, index in a bear market when the 50-day EMA moves below that 200-day EMA. So I want to have a setup, if I'm looking for shorts, that it would include this, if anything else, because it would, once you're in that bear market configuration, that's when you can start expecting bearish conclusions to pretty much all of the things you're looking at. You can weigh that more heavily. All right, so let's go ahead and run this scan just to see what we get. And I think there were only about 4. Oh, got 9. Excellent. All right, so now I have my group, and I want to look at them and see how how doggy they actually are. So I'm going to replace a chart list. What I do is I have my scan dump, I call it. This is a transient chart list. I never save anything. If I have something interesting, I would never leave it in here, because this is always going to be the spot that I change over and over. I'm always going to be replacing it. So it's a great way to just be able to get these so that you can manipulate them when you get your scan results. So I highly recommend you set up a scan dump, or call it whatever you want. All right, so now we've pulled all of these up. I find it interesting. We've got 3 industrials in here and 3 discretionaries. I've been looking at utilities in the positive, but we can see we have one, Edison, which is really the partner to PG&E out here in California. So they're getting, they're under pressure. I know a lot of it having to do with the lawsuits, I think, that are building on PG&E. I think it's putting downside pressure on Edison as well. So now I have them, and I'm going to look at them quickly here in Candle Glance and see if any of these look particularly interesting on the short side. All right, so you can see all these PMOs are configured exactly the way I want. And I really, if I'm looking for a short, I want to see a PMO topping below the 0 line. I want to see tops that are declining. This one's okay, but you notice that the tops are more even with each other. So I'm not getting that bearish confirmation I'd want with price tops. I want them both to be declining. This one looks pretty good right now. AAR Corp. It is a symbol AIR, A-I-R. And there you go. We've got the PMO turning down below the 0 line. It's broken an upside, rising trend in the short term. And you can see that really there's a lot more distance to go down before it hits support at 34. So this has come up for us as a shorting opportunity. And you can see that the scooter is on its way down. Volume is on the OBV. The tops are moving down here. So I think that this one actually looks pretty good as a short. And let's see, any others? I mean, some of these look interesting. That was the one that really caught my eye more than the others. Like this one looks interesting, Jack in the Box, but you can see right here this low back in November. Price is sitting right on top of it. So that to me is a possible support level, meaning we might get a bounce off of that. So I wouldn't want to jump in that as a short. This one, the PMO, you can see has been rising off of this bottom, and rising bottoms on the PMO and even or declining bottoms in price is actually a positive divergence. So there are things you want to look for when you do it. All right, I'm going to show you the code for my other scans. The other one I was looking at was my bottom feeders. That's my crossover scan. That's what it was. My turning point scan, actually. This one, all I'm really looking at are 50-day, 200-day EMA downside crossovers. So I'm going to run this just to see if there are any out there as of yesterday. And so I can run the scan here, and there are my results. Got 17 that are having just having 50, 200-day EMA downside crossovers. So here's your other, or I'm sorry, upside crossovers. So these are possibilities toward the upside. There we go. Because I'm looking for a turning point where the 50-day EMA is just moving above the 200. So that's a scan I'll put in. And then the other one is just my general PMO scan. And of course, you'll find this in many a blog. But if you just do a Erin Swenlin PMO scan, you'll get my articles in the search box. And I won't go through all of this because I want Tom to show me what he's doing right now with scans. But as you can see, what I'm looking for is a PMO that's been rising for 3 days. I want the PMO to not have crossed to the upside yet because I'm looking for something early. And then I want to have the 50 greater than the 200 because I am looking for a bull market configuration. And then I would very much like to see the 20 above the 50 as well, because that also gives me an idea. Scooter above 75. Now the question is, are we going to get positive scan results? And we only got 2 to the upside. Real estate, not a surprise. I wrote about that last night. And the floating rate bond. There we go, TFLO. This one, of course, is going to always just move just slightly up. So, not overly exciting there, but certainly something to consider. And O was the other one. And this one does look pretty good. You can see that's getting ready to have you've got rising bottoms, you've got that crossover, good scooter and all of that. All right, Tom, I hope I left you enough time here.
I can always squeeze things in. All right, taking a look at my scan, what I did is I started basically with the default scan from the member page and just changed a couple things here. Instead of a 20-day moving average, I moved it to 50, and instead of 40,000 shares, I moved it to 300,000. I'm looking at still the possibility of shorting based on the fact that we haven't gotten through the 20-week EMA. So as we move up, if we see a reversal, these are the types of scans that I would run. Scooter less than 40, so it's going to give me the universe of stocks that are underperforming many of their peers. Because we've seen this rally, I want to find weak stocks where their RSI is now moved above 60, because usually that 50 to 60 area is pretty critical. If we're just above 60, many times that could be an indication we're ready for a big reversal. Use the closing price greater than 10 just to weed out some of the small stocks. When I short, I generally don't short the lower price stocks. And then today's volume more than 200,000, just so that I know that I'm getting stocks that are pretty liquid. All right, I ran that scan and I came up with 94. And from there, what I did is I sorted based on the scooter rank, because if I've got all these stocks with RSIs above 60, the ones that have the lowest scooter scores are likely to be the ones that are the weakest technically. So that's where I wanted to start. So what I'm going to do is I'm going to go through and pull up some of these charts that I had looked at that I thought were interesting and would be interesting to share. So I'm going to start with COMM. This is the one that I thought looked very suspect. You can see that the huge selling, this stock was 32 back in October, went all the way to 15. We've seen a bounce now to 19, but the volume's been really light. I think this is going to be a tough area for the stock to get through. The next one, and all of these, again, came off of that list. DXC. DXC, nice rally. This one's got a little bit more volume on the move to the upside, so I want to see if it holds the 20-day, see if it starts to display some more bullish characteristics. But I doubt it, because the selling was so intense from 97.5 down to 50. Lost almost half of its market cap in 3 months. So, yes, we're getting an oversold rally, but I don't think we're going to take out these prior highs. Next up would be AMG. This is Affiliated Managers Group. Today, now the whole group is performing pretty well, but we had a lot of selling in December that started at about this 110 to 115 area. So early December, we had a high 115, went all the way down below 90. Now we're getting back up pretty close to this 110, 115 area, something to consider. THO. THO is Thor Industries, another one. This is gap resistance right here, by the way, at about 63 and change. Currently trading 63.69. I'd be looking for maybe a reversal. If you see the stock get up 65 or so intraday, come back down, close around 63, that could be a topping candle. Again, something to watch for. C-Trip, of all of them, this one to me looks like maybe, depending on how we finish, this is one that has really got my attention, because we had gapped down on massive volume back around second week of November near $30. Look at those tails up there above the resistance area. That was a top. We went right back down. Maybe we're just consolidating. We're going to break to the upside. Yesterday's close was a little suspicious because we did get a higher close, but the volume was just average at best. I'd be looking for a reversing candle. I wouldn't short until I saw one, but a reversing candle, I could keep a pretty tight stop on C-Trip. Facebook's been on fire here of late. It did get up to this 150 level, and right now it looks like a little bit of a breakout, but when you stretch it out to the weekly chart, we are right at that 20-week moving average, and if this downtrend continues, this is where I would expect the reversal. So the stock is sitting almost squarely on its 20-week moving average. Next up, Ozark, or Bank of the Ozarks, OZK. Actually, that's right. They changed their name. Bank OZK. Big resistance area right here at about 28. After gapping down in October, the rally gets to 28. So far failing. We're getting pretty close to 28 again. This is where I'd look for a reversal. APTV, Aptiv, move up. It isn't a flag, so breakout with volume and what you want to respect, but the overall trend here is down. So a big move up intraday with a failure could signal a top. EDU, this is New Oriental Education and Technology Group. This is another one where I'd probably be looking for a reversal right here around 65. That's where we were before the huge volume gap down. Went up, we tested 65, couldn't get through. We've been putting in essentially sideways action here, but this is resistance until it isn't. So watch 65. Last two, let's do Mattel. Mattel, huge volume selling back in December. The stock went from 14 to 9. Yes, it's moving up. Look at the volume, though, drifting lower as we make this move. It looks like it's running out of steam to me right where I would expect it. 12.5 to 13, I think this is a good short area. The last stock I had is WLK. This is actually one on that list, but it's starting to look better to me. Look at the volume come in. It breaks the downtrend. It actually put in a higher high than the one we saw in December. Pulled back, I think the 20-day moving average actually off of this kind of dog list that I pulled up. This one actually looks like it's starting to make a turn to the upside, possibly a bottoming head and shoulder pattern, reverse head and shoulder pattern. So those are the stocks I had for this technical scan segment. So there is a summary of what Erin and I just came up with. And going to be an interesting finish to this week. You know, Netflix reports tomorrow after the close. And that's going to be a big one considering what that stock has done over the past, last 3 weeks.
Sure. And I know the market participants always look to those FANG stocks as a bellwether of what to expect in the rest of the market.
Yep, and we've got a minute, so I'm going to go ahead and pull that Netflix chart up here. So let me take a look. Netflix, by the way, was at 230, and it is now back above 350. Here's the chart. Beautiful move. And the volume, you can see there was a lot of accumulation taking place. Yesterday, one of the reasons we got this big move up is they announced that they're going to be raising prices. And that, to me, is a good sign. I mean, in an environment where you think, well, the economy's slowing, all this competition, last thing you'd be thinking about is raising prices. They must feel pretty good about their business model if they're willing in this environment to raise prices. I do think, though, now that there is a lot of really good news built in off of this move. So I think Netflix is going to have a really good report to extend this to the upside if it's going to challenge the October highs that we saw. What do you think about Netflix?
Yeah, I mean, I like it as well. I just worry a little bit because, the technology sector has been somewhat lagging. It's an aggressive sector. I haven't been expecting it to do all that well. But, of the FANG stocks, I really like Netflix and Amazon. I think they both look pretty good. Of course, their business models are solid. Netflix, I'm getting very impressed with them, and raising the rates, all of that sounds great. So I'm a fan, but I would be looking for a pullback and then maybe taking advantage there.
Yeah, I think you made a couple good points there on the FANG stocks because I agree. I think Amazon and Netflix have been the two really good ones in that group. The others are still struggling, trying to get through their 20-week moving average. So there's some definite technical issues there. You see the upcoming schedule. I do want to thank everybody for being with us today. Special shout out to Dave Keller for stopping by. Always good to hear from Dave. Please remember to complete the survey as you exit. We'd love to get your feedback, hear what you think of Market Watchers Live. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. We'll see you back here tomorrow. Happy trading. day.